What I do know is that we're under the cost of production for a primary silver mine substantially. There's a lot of words on the internet from analysts that are, fairly respected, especially from the banking perspective, that are looking for $14 silver. I don't see it going that low, but I'm not going to say it won't or it can't.
This video is brought to you by Reluctant Preppers. Click here to subscribe for free to reluctantpreppers.com. Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and back with us today is silver expert David Morgan. David, thank you so much for joining us today.
My pleasure, Elijah. Thank you.
So I first wanted to discuss about what is happening with the silver market right now. Today is Tuesday, September 30th, and we're actually seeing silver right now below $17. It's just below $17. What do you make of what's happening in the silver markets? It seems like it's getting smashed.
Well, it is getting smashed. There's no ifs. The support level is about 1750, and obviously, as you said, we're under that intraday trading off another 50 cents. It was actually holding that level for a few days, but it's broken that. So it's really difficult to say, other than there's a lot more selling than buying. Obviously, on the futures markets, they have to match. But the reason the price drops is that there's a lot of sales, and they have to match, and so people aren't willing to take the other side until the price goes lower. And once it's lower, then the orders get matched. So there's selling pressure in both the markets, gold and silver, actually platinum, palladium as well. If you look back to palladium, that's been the star performer of the four metals in the last several months, reaching over $900 recently. It's under $800 right now. So all these metals are getting hit pretty hard. There's all kinds of reasons that are given by the mainstream press, predominantly the U.S. dollar strength. But and that's true. I mean, the U.S. dollar on the dollar index has gone up rather significantly for the last few months. But I think it's a little deeper than that. I think that there's a lot going on behind the scenes. If you look at what Kuz has done with the reports that he does, he has indicated how much physical silver has been taken off the Hong Kong exchanges into the Chinese market. And the Chinese market is pretty vast for physical gold and silver for that matter. So it's really difficult to get a handle on exactly what's going on. We certainly know that the derivatives markets is pervasive throughout all the financial markets, predominantly in the interest rate sector, more than any place else by far. It's the debt markets that carry the biggest amount of financial burden, well beyond what the gold and silver markets entail. So there's a lot happening behind the scenes, and fundamentally things really haven't changed that much from the 2008 crisis. Certainly we have gotten through that in a manner that has given, I would think, a false belief to a lot of people that it's behind us and things are better. They certainly seem better and appear better, and for maybe even practical purposes are better, but the problems have not really been addressed. In fact, they're getting worse as far as the amount of debt load and the amount of derivatives are back up. And there's less banks to carry the burden, so we've gotten fewer points of failure that could rile the system again. So on the big picture, Elijah, my perspective is that this is a more of an illusion about how strong and good the economy is, about how strong the U.S. dollar is, and how wonderful things are, rather than giving a clear, explicit picture of the actual facts that we are really having to live with in the debt markets, the precious metals markets, the stock markets, and the overall economy. I want to go on just a moment to say that I want to not, give the impression too much of a gloom and doomer. I try to be a realist, and certainly there are areas in the economy that are always doing fairly well. I mean, the entrepreneurial spirit of the United States and other areas, I mean, new inventions, new ways of doing things. This 3D printing is pretty popular. It looks like it's got a long ways to go. There are better methods throughout the technological sector. I mean, if you look at, what the original cell phone was like compared to what a smartphone does today. So that isn't to say there are not bright spots in the economy and that, certain areas are doing better. But on balance, the big picture again is that the overall American, really in real terms, in real wages, hasn't done much since basically the mid 70s. Their real purchasing power has gone down, even though the amount of quote unquote money has gone up. So again, there are bright spots, but the bright spots that I see are not significant enough to cause what I would consider to be a substantial boom in the economy. In other words, there's not enough innovation or whatever, at least at this point in time, that I see, because the debt burden is so big. That's the main problem, obviously.
Right, and getting back to what you were talking about, the derivative market, I know in a recent interview with Butler on Business, you said that the paper commodity markets have become, quote, big speculative casinos, and that the cover ratio in all commodities is greater than the physical reality. But for silver, as far as a coverage ratio goes, it's extraordinarily high. Did you want to discuss a little bit about how this impacts the silver price?
Sure. In fact, if we go back in time and turn the clock back maybe a decade or so, when I was doing a regular show with Jim Popova on Financial Sense NewsHour, he actually asked me to write about the manipulation, and it's still on the website. I think it's probably archived in my archive file on my website. But what I said, and it still holds true, is for a very long time, the market doesn't care if you're being supplied paper silver or real silver. Now, let me explain that, because obviously a manufacturer that needs real silver isn't going to take a paper promise. So the underlying part of that is that as long as there's enough physical to go around, the market doesn't care how the supply is met. So most of these futures contracts and derivatives contracts are settled in cash. In fact, most of them have only one purpose, and that is to settle in cash. Very few people actually are in the derivatives markets to obtain physical commodities. And that's true across the board, meaning it's true in the corn market, it's true in the soybean market, it's true in the oil market, it's true in all these markets that are on the futures exchanges. Most of the physical commodities that we're familiar with are sold in the forwards markets, which are over-the-counter markets that aren't transparent to the public. And these operate similar to futures contracts, but yet they, again, are not accounted for anywhere with any regulation. And so these type of contracts, which are done by individuals, groups, entities that basically specialize in that, will make contracts in these commodities, and that's where it basically gets sold. For a quick example, in the silver market, some of the largest producers are base metal mines, and they have contracts either directly with a silver user, probably through the Silver Users Association, or indirectly through a bullion bank that supplies somebody that's a member of the Silver Users Association. So they may additionally, in fact, in most cases do additionally go into the futures market to quote unquote hedge, but that's only a paper product, and they know that full well. The physical supply has already been negotiated, and the contract is there for delivery to whomever they have done this deal with. So a lot of that is what really takes place in the market. And I had a misperception when I was much younger that, almost all these commodities flowed through the exchanges, and so that you could get a pretty good idea of what was going on in the wheat market. If you watched, what the inventory of wheat was and the farm reports and all this stuff, not saying that some of that doesn't have merit, but what I'm suggesting is that all these commodities have such a huge cover ratio, and some much greater than others, silver being exceptionally high. Some commodities have cover ratio of, 30 days or, 40 days or that type of thing, where silver is several months. And this is unusual, but what it shows is the amount of paper to physical is much greater in silver than probably any other market, at least in the transparent markets. We can't really state that in the over-the-counter markets, other than you'll get information that's kind of leaked out once in a while. Bloomberg put out something about the $5 trillion silver market versus the $14 trillion gold market. Now, where they got those numbers, I don't know, but it was a pretty reliable source, Bloomberg, which suggests that on a paper basis, there's basically 1/3 the volume of silver that there is gold, yet the ratio is like at 70 to 1. So again, I just want to emphasize the point. For whatever reason, silver has a huge cover ratio relative to any other commodity that's traded, be it, the agricultural commodities, the softs, anything else. Probably the only other commodities, if you want to call them that, are quote unquote money, which I mean debt. And the trading in debt, of course, is huge relative to any other market. And what the ratios are would be hard to say, but I wouldn't be surprised to see that it's even greater than what's in the silver market, meaning that there's so many swaps and derivatives upon derivatives that are out there based on interest rates that it probably does dwarf the silver market, but it's very difficult to get a handle on that as far as what the amount is other than the notional value, which is a much bigger number than the actual true number that it represents because the leverage is so great.
So how do you think this is impacting the silver price right now? I mean, do you see that this is a significant reason why we're seeing a decline in the silver price?
It is. I think that it's going to take whatever it takes. I mean, I would love to have, definitive answers. It's going to stop on this, point in time at this price because of this reason. But I don't have that. What I do know is that we're under the cost of production for a primary silver mine substantially. I know that all bottoms, eventually take hold. I was thinking that September would probably be the worst month. We've got another day in September. I felt that in October we'd probably get a turnaround of some type. That may be true, may not. There's a lot of words on the internet from analysts that are, fairly respected, especially from the banking perspective, that are looking for $14 silver. I don't see it going that low, but I'm not going to say it won't or it can't. Silver can surprise just about anyone, including yours truly. What I do know is that fundamentally, it's at a very opportune buying point, because if a primary silver producer produces it at $22 or $23 an ounce total all-in costs, and it's at 17, you're doing much better than a primary silver producer is doing if you buy it and hold it. And those type of situations, commodities usually don't last a very long time. In other words, they usually don't last, month upon month upon month. If they do start to drag on, then what happens in any business, silver being no different than many other businesses, they're there for a profit. And if they become extremely unprofitable, the business decision is made to either stop, curtail, put on hold, or some way or manner to cease the activity or drop it down into a very minimal state. And that, of course, puts supply pressure upon the market because there's less supply. And with less supply, generally speaking, you're going to see prices rise. So I think the market is not accurate in its pricing at all times. I mean, if it were, there would be no point in trading these markets or investing or anything else. So, as Warren Buffett says, and I'm not a huge fan of Mr. Buffett, but as he says, Mr. Market makes mistakes from time to time, and an investor should take advantage of that. Now, did I foresee silver dropping to this level? And the answer is no. I thought that the 1817 low would hold. It didn't. Once it got under 19, I put out an alert to my members saying, I'm certain that the 1817 level will be tested. And of course it was. And obviously We're below that now. So it's difficult. I mean, I don't know, I don't want to mix my words. I want to be clear. It's difficult. It's a bit surprising. Uh, Also, the fact that the 1750 level has been broken. We'll see if we get a close above that today, but certainly doesn't look that way. It certainly looks like it's going to trade at the 17 level for quite some time. And if it closes on the low, which it looks like it may, then that's bearish. Anytime a commodity, I don't care which commodity it is, closes on the low of the day and drops significantly and trades at that low level the whole day, you're almost assured that the next day it'll drop even further, maybe not as substantially, but it's bearish when you close on the low. And conversely, if you close on a high, it's bullish. But we haven't had much cheering to do, Elijah, in the precious metals markets for some time, other than, as I mentioned, the palladium market, which was leading the sector up until very recently. It seems that once that it made a new high in such a thin market, very few people pay any attention to it at all. But once it had made a new high, it seemed as if that was a threat almost. And from that point of making that $900 print, it's been down, down, and down for palladium as well as the other metals.
Definitely. And while we're seeing the precious metals under pressure, we're also seeing the dollar strengthening. You recently wrote an article titled, "The US dollar is the last stop before the gold and silver spike," in which you said that the run to the dollar is a precursor that is absolutely necessary before the run to precious metals. Did you want to talk a little bit about this?
Sure. It's an article that I actually from a couple of interviews. I did an interview with Butler on Business that I do every Monday, and then I was on the Greg Hunter show, USA Watchdog, and I talked about something I'd written before, which is the Exter pyramid. John Exter, for those that aren't familiar, you can Google him and get more information. But he was president of the Federal Reserve Bank in New York, pretty much known as a gold bug. And he had what was called the upside down pyramid, which shows the financial markets and how they actually operate. And it's a very good analogy of how the system is. Because if you picture an upside down pyramid, the pyramid continues to expand at the top, and that's exactly the way the system is set up. In order to have continual growth, which is how the system is mandated, it has to grow. The money supply has to grow. Then you continually get a bigger and bigger base. And of course, the interest isn't made, so the interest has to come in some other form later in time. And of course, the debt just keeps compounding. So what John did was he took this upside down pyramid, explaining that the debt always increased and that there was different categories of financial instruments, some being more safer than others, some having more confidence than others. So for example, the derivatives have a very low confidence. And we saw that in the financial crisis of 2008. Basically, what happened was there's a total loss of confidence in these mortgage-backed securities, and that banks didn't trust each other. So that sector, or that part of the pyramid, which was vast, started to unravel. And of course, the Federal Reserve came in and saved the day. But then, so underneath the derivatives, there's other instruments, other debt instruments that are not as, let's say, toxic as those. And then you come down the pyramid. Well, as you come down the pyramid, you get into safer and safer investments that are held by investors and felt to be much more, have much more confidence. So the most confident sector that you can have outside of the precious metals is a physical note, a Federal Reserve note, a Euro note, an Aussie note, a Canadian dollar, whatever. And that is at the very next to the tip of the pyramid. And so, for safety purposes, as an example, if someone had money in the bank and they were worried about a bank failure or a bank run or whatever, and they actually took their money out of the bank physically and had it in cash and had it under their mattress as a metaphor, they would feel extremely safe. If something happened to the bank or something happened in the financial markets or whatever, they're in pure cash. So that is the step that probably 99% of people that are concerned about the markets would take if they felt the situation demanded. In other words, they were very fearful of the financial future or the banking system or the financial system or whatever. So that's a rare event. And of course, before that, what you have is you have a run to as good as cash, which really means a run to the dollar or the euro or whatever, primarily the dollar because of its status as the backing the oil markets. And so you're getting out of stocks, getting out of bonds, getting out of some derivative instruments and moving into cash. And that's very easy to see, and supply and demand applies. And so there's a more demand for cash and less demand for these other instruments. And that means that the dollar has got pressure to go up. And it is. But if you look at the pyramid, that is a step before there's a run to gold. So what causes the run to gold, of course, is that final confidence factor that everyone is, not everyone, but many people are voting and saying that, the dollar is the best place I can be. It's the safest place I can be. I have the most confidence of anything I can do as I own the dollar. And that confidence shifts.
Hey everyone, thanks for watching. That's it for part 1. Make sure to click here to subscribe so you will be notified when part 2 is released. This video was brought to you by ReluctantPreppers.com. Click here to watch Reluctant Prepper's latest interview, where Bill Murphy explains what your family needs to know about gold and silver.